Okay, recording is started. Fire away, Brad.
Sounds good. My name is Brad Burns. I'm with Finance of America Reverse. I'm your account executive on anything reverse related. My backstory is I've been in mortgage since 2000, always retail. Started selling reverse 2006. Joined Finance of America about 8 years ago. And as an AE, that's the first time I've been in wholesale. So my background's retail, outfront selling. So as an AE, a little different just because I've been most of my career pitching these products and dealing with that side of it. So it gets me a little different insight. And the way I built my team was more like we're your reverse back office. The goal is to pull away any barriers to entry and say, okay, let's go look for reverse opportunities. What is a reverse lead? What is a reverse opportunity? And then let my team assist you. We can help with proposals, disclosures, processing, whatever. We can be hands on or hands off. So it really just works to how you guys want to work with us or learn. You have a lot of resources here. But the big takeaway right now is going to be how to identify an opportunity. And then, we have a lot of product mix and more products coming. So that's the big thing in reverse world is there's always just been the FHA standalone HECM, right? Home equity conversion mortgage. But at FAR, we do have a lot of other products that I'll be going into, and hopefully that will kind of give you an idea of, okay, there are some opportunities here that I'm missing, and now I can identify those. And then once you do that, then obviously the team is here to help. So when you look at the basic concepts of a reverse mortgage, I want to know what my clients are, what my customers are thinking. The top goal in retirement, but I kind of look at this is goals for everybody. But when you're thinking short term, long term, talking to a client, talking to a senior client, they might call you and say, I'm struggling. I need with my mortgage payment, or I need to pay off debt, or I want to remodel my property. That might be the short term goal. But when you're looking at the long term play, when you're talking to a senior, it's have enough money to last their lifetime, remain financially independent, and stay and live in their own home. Now, why I show this is I always refer back to this. And when I was selling reverse, yes, I can take care of the short term goal. But if I can take care of the long term goal for them as well and take away those fears or those stressors, then this is something that I can get them moving forward. Because now they're going, well, if I get a reverse mortgage and I pay off my mortgage and I pay off this debt, but then what? I'm afraid. Well, if I can wrap it around the big picture, short term, long term, then I'm taking care of those fears and those concerns and overcoming those objections. Now, why reverse mortgages? I mean, it's kind of right in our face. It's over 10,000 seniors turning 62 a day. And now it's up to $16 trillion worth of equity that they have. So we have products that start at age 55. So that's great. We can start looking at these opportunities age 55 plus. But the big thing here is the amount of equity and the amount of seniors, right? That's an opportunity. It's a major opportunity. And when you start looking at the retirement outlooks, this is even worse today than it was in 2018 when we ran these. But you're looking at seniors don't have a lot of money in their retirement. They don't have a lot of cash flow, right? They know that Social Security isn't going to be able to cover them. Current cost of living, inflation, the medical expenses, you can go on and on and on. Every road leads to the same place. The equity is going to have to bridge the gap for the retirement community. For seniors to retire comfortably, they're going to have to use equity, and equity is going to, be a major player in retirement for the senior market. Now, today, FHA HECM, home equity conversion mortgage. Yes, you can do refis. You can do reverse to reverse refis. A lot of people get tripped up on that. They don't think you can rewrite an existing reverse mortgage. And the truth is that we honestly rewrite our reverse mortgages every couple of years. The senior gets older, so they qualify for more money. The value of the property might go up, so they can qualify for more money. All those things play a factor. And after coming off the current market, as soon as rates come down a little bit more, you're going to see every reverse mortgage that we wrote the last 2.5 years is going to get rewritten because their older values are up and rates are down. So you'll have the perfect storm to rewrite the existing reverse mortgages out there. You do have reverse purchase market, and then you have our prop products or our Home Safe Standard, Home Safe Select, and Home Safe Second. Our Home Safe Standard is nothing other than just a fixed rate opportunity. Our Home Safe Select is an adjustable rate with a line of credit. And then we have our Home Safe Second, which I'll go into detail. But yes, we do have a reverse second that will go behind a traditional first trust deed in place of, let's say, a bank line of credit. Now, what is a reverse? What is a HECM? I don't like to really go deep into this because a lot of seniors get tripped up, and a lot of people go, if you say the word reverse mortgage, they'll close down on you. They're just not educated to the point to understand it, which is unfortunate. So we have to get through that first barrier. So you can call it a home equity conversion mortgage, and they'll open up to you a little bit. But we're starting at age 55. We only deal with primary residents. We do not go on title with them. They're not giving up title. We're just a simple lien like any other loan. We do not have a prepayment penalty on our loans. So I like to attack it more like a traditional loan. A reverse mortgage is no different than the loan you possibly already have or had in the past. There's an interest rate, a simple lien on title, no prepayment penalties. You're not giving up equity position or share of future equity. You get a mortgage coupon each month that shows what the deferred interest is, and then you can make a choice. Freedom, going back to that first slide, freedom to make a payment or no payment. Now, most seniors will not make a payment to a reverse mortgage, but you can talk to them with that opportunity because that's what they understand. They understand the idea of making payments to something when they borrow. So here the idea is you can have the equity in the mortgage make the interest payment for you, or I'm sorry, the equity in the property make the interest payment for you, or you can make a payment yourself. It's really up to them on how they want to attack that or let it ride. And that's just no different than just having freedom to make a choice. I'll go back into making a payment on a reverse mortgage here in a second. But all our products, you can make payments to all our products. All our products, they'll get a coupon. Like I said, most seniors will not make a payment to it, but it is an opportunity. And when you discuss it that way, it's something that they're used to. So you're not going outside the box. This is too good to be true. It's not scary to them. Once again, 55 plus, owner occupied, primary residence. Our LTV curves are based on age and equity. The older they are, the more we lend, right? The lower the rate is, the more we lend. With the idea, the older they are, the sooner we get paid back. The lower the interest rate, the more we lend because you're deferring less equity or less interest eating at equity at a slower rate is the idea behind it. We do lend on SFRs, 2 to 4 units, condos. We will do single unit approved condos. We do manufactured homes, single wide, double wides. So it's really wide open as far as financing on that market. Now, the big players here that kind of throws a curveball is we don't go on DTI. We go on residual income like a VA loan. And we find residual income is much easier for the seniors to qualify for. Most seniors will qualify with just some basic residual income factors, not unless they have a lot of debt. They're living on credit card debt, might become a problem, but with some of our products, we can look at paying off debt to help. But most times it's going to be residual income, qualifying with some Social Security income and some asset dissipation. And then FICO scores, another one is we're not really FICO driven for most of our products. The one product that's FICO driven, this hardcore FICO driven is our Home Safe Second. We need a 640 FICO or higher to run that product, but I'll get into more depth on that. But on an FHA HECM, you could have a senior that's 640 FICO, NOD, or BK or whatever, we still look to write that loan for that senior.
Hmm.
So on a reverse, what is it that's attractive? I look at this as a traditional loan. I go back to the first slide. It's flexibility, monthly payment. Everybody preaches the no payment, no payment, no payment. But it's flexibility to make an IO payment, to make a pick a payment, pay to create more liquidity. If you're paying into the loan, that's paying down the loan balance, and paying down the loan balance increases the line of credit. And then all our lines of credit have growth rates to that. So if the line's sitting there, it's growing over the senior's lifetime, giving them access to more funds. So there's some very powerful flexibility and freedoms there. What we usually write, 95% of what we write, is an adjustable rate mortgage with a line of credit. Why? Is because the senior wants access to equity over their lifetime. They don't necessarily want mattress money. They don't want to be charged interest on funds they're not using, but they don't mind having a line sitting in the background like an insurance policy in case of emergencies. They'll take money out to do whatever their intent is, to remodel their property, to build the ADU, to help their kids, buy a home or pay off debt, whatever it may be, but the rest they want sitting in the background in case they need that emergency fund. Now, there's no limitations to use of equity. It's really wide open. It's like a cash out refi. The equity or the money is non-taxed. So make investments, rental properties, I said, right? I've seen seniors go out and buy multiple rental properties, bring more revenue streams and increase their life estates, help their kids buy a second home, remodel. It's really 100% up to you on how you want to use that, right? Now, a lot of people get tripped up on this fixed versus ARM thing. We've taught the universe to fixed rate, fixed rate, fixed rate. So usually they'll come to you with, I want a fixed rate. I only know fixed rates. Well, most of what we write is adjustable rates, and the reason why is this kind of breaks it out for you is a fixed rate's a one and done lump sum, so there's a lot of mattress money there potentially for them. They might not get as much either as far as what we consider a principal limit, so they might qualify for less than a fixed rate, and they've got to take it all. On an adjustable rate HECM, there's flexibility, right? They can take what they want, leave the rest on the line of credit, or create a combination of line of credit, 10-year term payments, cash out. So there's way more flexibility in the ARM products than there are in the fixed rate products. So we write 95% of what we do is ARMs because of that flexibility. Now, getting into a reverse purchase, I'll hit on this a little bit. It is a popular thing. We do write quite a few reverse purchases. You're talking about seniors that want to relocate or what we call right size. Maybe they're going through a divorce, silver divorce, we call them. There's lots of different reasons for it, but what you can see is, like, let's say this senior client right here, they're looking to right size. They want to move to a more retirement friendly state. They might want to move into a 55 plus community, closer to their kids, whatever it is. They want to go from a 2-story to a single story, smaller property. They're right sizing. Now, instead of going and selling their current property and then buying all cash in the new property, which they could easily do, what they want to do is use some of the cash and then move into the property and have liquidity. So they have access to equity, or their path to equity, to help with retirement. This works out great for them. They're able to go buy this new property with a reverse purchase, use some of the proceeds from the sale of the family home, and have no payments for life, and then have leftover equity. The other way we see this is to increase purchasing power. So let's use a different example. Maybe the senior has $400,000 down from selling their family property. They don't have good FICO. Maybe it's 500 FICO. Their DTI is a little off. You just can't find them any traditional financing. So they're going to have to try to find a home for $400,000 all cash offer. There's no inventory at $400,000. So what are we going to do? With a reverse purchase, you could increase their purchasing power With 400,000 down, maybe they qualify for 750, $800,000 property. Now we can open up inventory for them, get them to do a, let's say, an $800,000 purchase, 400,000 down, move into the property with no payment. That could work because we're not FICO driven. That could work because it's not DTI based. So this allows you to open up purchasing power as well for a senior client. Our portfolio products are home safe, is what we call them, very similar to an FHA HECM. All our products are non-recourse. Non-recourse meaning that you can never owe more than the value of the property. If you ever did go upside down, nothing's past the heirs as far as any liabilities, the insurance policy on all our products would kick in and pay the difference. So that's a nice freedom aspect. All our products go off a financial assessment. Same idea, residual income is what we look at. All our products require counseling. We do allow leases. A lease is an impound account. So if you had a client that wants to build an impound account, we can do that. If you had a client that was in BK NOD foreclosure, we would force an impound account on that file because of the derogatory credit. So it's not a no, we can't do it. It's the, okay, we need to add a lease or an impound account to your loan. Now, the difference between HomeSafe and HECM is the loan amount. You can get up to a $4 million loan amount on our HomeSafe products, where FHA does not have that high limitation. We don't have seasoning requirements on our HomeSafe, where HECMs have a 12-month seasoning on cash out over $500. So there's a lot of nice things there. But the big one that you'll hit on is age 55 plus and no upfront mortgage insurance premium on our HomeSafe products. So if you have a senior that's hitting on, well, the fees are just too high for a home HECM or an FHA loan, our HomeSafe product might be perfect for you. Starts at age 55, no MI, upfront MI, and then or monthly, and it goes up to a $4 million loan amount. So it plays very nicely in the high value states like California. Here's a sample of a HomeSafe Select product to where a $2 million property, the senior wants to pay off, get rid of her monthly mortgage payment, and she wants to save more money for retirement. So in this scenario, she's taking a monthly mortgage payment, the savings, investing it, and then she also has a line of credit that's going to grow for her over her lifetime. So in 15, you can see the difference in 15 years. She goes from basically savings of 175K to roughly over $1 million based on this idea. So yes, it's not just short-term, eliminate the monthly mortgage payment. It's long-term savings planning, right? You can take care of those both short-term and long-term goals for that senior client. This is one I talk about a lot because to me, when I was selling reverse mortgages on a retail side up front, you get fence sitters, and fence sitters basically are the ones that say, I'm still working. I don't need a reverse mortgage right now. I'm just looking to refi and lower my monthly payment. I'm not ready to go reverse. I'm still working, or I'll do it later. I'll do it later. And, the statements that I always found worked were like, look, I don't know about the crystal ball. I don't have it. I don't know what the future holds for you. But I do know that you need to insure things. Now, do you get insurance before the accident or after the accident? And they're basically, well, you get insurance before, 100% right. The other one is going to be, do you start planning for retirement the day you retire or before you retire? Well, you have to start planning before. So all these things to me open up to this idea of, I don't care if you're still working. I don't care if you plan on retiring in 7 years. If you get a reverse mortgage today and you start making payments for that reverse mortgage and treat it like a traditional loan, then I might be able to show you that instead of making $2,000 a month mortgage payment, you're making $1,500 a month mortgage payment. And you called me to save money and you're saving $500 a month, but that's your short-term goal. We accomplished it, and I'm not recasting your loan at your age. And now you're paying down the loan balance and paying into your line of credit. And I can show you this in amortization schedule. And then after 10 years, look what happens. you go from 200,000 to 300,000 in your line of credit, and now you've improved your portfolio and your retirement is set. That's great. But there's also another factor. What if something happens from age 63 to 70 where you can no longer make the mortgage payment that you want? What would you do? You'd have to start liquidating your assets, maybe live on credit card debt, run into some real big issues, and maybe not be able to afford the mortgage payment and go late and lose your property. That's your snowball effect. If you did a reverse mortgage today and you made payments to it and something bad happens to you in 2 years and you can no longer make the payment, nothing bad happens. We don't report to credit. You are now letting the equity pay the mortgage payment for you or the deferred interest until you get back on your feet, and then you can start making the payment again. Now, that's a real conversation, and that goes to something where I try to use a lot of, because if you get a fence sitter that they're not ready for it, you have to talk to them about, well, I get insurance all the time with the hope I don't need it. You can get a reverse mortgage and use it in a retirement insurance and hope that you never need it.
Brad, real quick, do you guys have a calculator that does that for us so we can plug in those scenarios? And
Yes.
you do. Awesome.
Quantum Reverse is the system that you need to use to create your proposals.
Mm-hmm.
And then on our For Wholesale portal, you can manipulate the amortization schedule. And I'll go in there later and I'll do an example for you.
Nice.
Okay?
That's sick.
So on a Home Safe Second, we talked about it. This has been a big popular player the last couple of years because rates are up. So a lot of people are back in the second market. If you've been in the industry long enough, you know this is a cycle where you go first and seconds, first and second. So in this one, what we're talking about is reverse seconds have been a big player for us the last couple of years. Seniors might have a low rate on their first. They're comfortable making that payment, but they want access to equity for some reason. And now they're able to get a second trustee in reverse with no payments. Much better for them than a bank line of credit, because we see when they get the bank lines, they use it, they have a payment, they might not be able to afford it, and then it's going to balloon on them at some point. So a reverse second's been a big player. It's weird that the most I see it used is they take the second, help their kids with the down payment on their own property, letting their kids get in the market to build their own equity. And there's no fear that the kids now make a payment to them or not, because if they do or don't, it's not going to affect them. It's an early gift. Versus if you refi your house to give the gift and now you have a higher mortgage payment, and if the kids don't come through and helping you, now everybody's in jeopardy. Mm-hmm. So this early gift or early inheritance play out has worked out well in the second position. I'm not going to play this video, but we do have a great video on our traditional market, our traditional first trust deeds, and our reverse seconds on our portal. And they're non-branded videos, so you can use these on social media or send these out to your senior clients. It does a really good explanation of the products as far as to the consumer base. We've already discussed different ways you can use cash. There's no limitations. Doesn't matter if it's a reverse first trust deed or reverse second trust deed. The equity position and using it, there's no limitations. It's really based on your imagination. Like I had a gentleman I did a loan for, not me, one of the brokers did in Newport Beach. It was like a $17 million property. We were able to get an exception and get $7 million. Wow. He didn't want his kids to fight over the property, so he went out and bought a huge apartment complex and put it into a generational skipping trust and had all that money going in the trust from the rental property or the apartment complex, and feeding his kids and his grandkids and the way he set it up. So like I said, just different ways to use it. It's pretty crazy. Now, using a second versus a HELOC, we already discussed it. We do have different rate options on our seconds, 899 and 949, depending on what your senior's looking to do. But, here's the big play, the difference, right? no payment is the big catch. No recasting, no running into trouble with that payment. Credit cards, that's a pretty easy solution. Getting a reverse mortgage to get equity with no payment versus a credit card and living on credit cards. Pretty simple. We all know that one. And then personal loans, the same idea. Instead of going to get money to do the remodel, getting a personal loan, it's better to go get a second and then use it that way than going to get some type of personal loan for some remodel or something of that nature. And then you can see the features. We've talked about it already. No additional monthly payments, preserve your current low mortgage rate and lend up to $1 million. This is focused on the HomeSafe Second. We go up to 1 million on the second, 4 million on the HomeSafe First Trust Deeds. Product overview. I warned you I was going to go over a lot of information, but the idea is to identify the lead, identify the opportunity, and my team's here to help. So FHA, HECM, one senior has to be 62. You could be 62, married to an 18-year-old, and we still could reverse this, okay? We can look at that as an opportunity. So you need one spouse of age, right? And then on our HomeSafes, you need 55 plus, okay? And then you can see the differences between HomeSafe and HomeSafe Seconds. So we have more products coming to market. Hopefully we'll get those out in the next couple of months as well. So this is just going to get bigger and bigger because the market is there. There is a huge market. There's a huge need for the product. And it's always just been limited to FHAs, but now we are having our own portfolio product. So you'll see those coming more to market. So where we go through the steps is where people get tripped up. And my team will help with all these steps. But the first one is we're not TRID. So you're not going to harm anybody here. But we need to create a proposal. That proposal has to be done. That's the one compliant component that has to be done. So you have to create a proposal. From the proposal, then the senior has to go through counseling. They'll get the list of companies through the proposal. It's 30 to 45-minute phone conversation over the phone, going over the different opportunities for the senior. So now they've been counseled by you and by a neutral third party. Seniors are a protected class, so this is going to protect you, the senior, the lender, everybody, okay? And then the next steps you're used to, disclosures, ordering services, submitting the file. And we're running about 22 days or less right now on our submissions. Clean files, obviously, if seniors are tech savvy and DocuSign, things will go faster. Now, people always ask, well, what's the financial assessment? This is what we look at. Now, if this doesn't pencil out, the worst thing you're talking about is a LISA, that impound account. So mortgage debt, installment, revolving, taxes, and insurance. If we have a derogatory situation, meaning I was late last year for 3 months because I was in the hospital, or my spouse passed away, or whatever it is, if they're an extenuating circumstance that we can prove and document, then we can waive the lates and waive the LISA or that impound account if the senior doesn't want it. Okay. So there's flexibility there as long as it wasn't like, oh, I just forgot, or, oh, I chose to do this versus that. I didn't make my payment. If it was something that was outside of their control, then we can have an extenuating circumstance. Now, what is it that we look at for residual income? Family size of one in California is $589. So you're taking their income minus their minimum revolving installment, tax, and insurance, and they have to have this left over. But there are comp factors we can use. Like you can use reverse proceeds as a comp factor to help them pass this. And this is all in the Quantum Reverse LOS that my team or you can run yourselves, but it is simple calculations inside the LOS system. Now, compensation. Everybody wants to talk comp.
Yes.
And compensation is wide open to you guys. You're not stuck to a comp bucket. So it's really based on how you structure each file. On adjustable rate mortgages, on all adjustable rate mortgages, you get both lender paid and borrower paid compensation. You get front and back. On fixed rates, you only get lender paid comp. You don't get the origination fee, okay? So most of what we write is adjustables. So let's say in this scenario right here, you chose a margin of 2.5, getting the senior a 7.5 interest rates. Rates are much lower now. This is an old chart. So rates are in about 6.5 right now. So at a 2.5 margin, the index are lower, your B initial rate about 6.5. And if let's say they qualified for $1 million, and of that $1 million, they only want to use $500,000 of it, pay off their mortgage, get some money, whatever it is. So now you're at 50%. So your comp is 5.7 points times the $500,000 based on this scenario. Okay. So it's really wide open, plus an origination fee. Okay. So you can make some good money on these products. Our comp is maxed out at $100,000. And I did write about 7 of those checks last year. I've already written 2 of them this year. So you can pull some good back-end lender paid comp on these files. Now, understanding the mechanics is once you get a comparison page, you'll be able to break it out. The margins, the utilization. This isn't giving you the right math problems because you have to know what they qualify for, principal limit, and then how much of that they qualify for are they using, and then you can figure out the back-end comp. Now, next steps, we've already hit on them. Send an email over to Team Brad at FAR so we can get you credentials, so you can start creating some marketing, get into the LOS system so we can help you out there, and you can see your pipelines. Conversation starters is, I always get the conversation of how do I get reverse leads? The answer is let the universe know you offer the product. If they don't know you offer this product, they're not just going to come to you on the street and talk to you about reverse. You need to have conversations or let people know this is a loan you offer, and I guarantee you they'll come to you. Marketing, we have a lot of great marketing in the portal. I'm going to jump in there in a second and show you. You can customize your own marketing. We have a quick pricing engine. It does pricing. It won't do that proposal that you need, but it will give you some quick pricing idea. I'm going to show you a sample of that. We do have a university where you can take courses depending on how deep dive you want to go into this product. And then we do offer help. Suggestions, mine is if you want, there's a quick learning path to just go over the basic concepts of reverse. I would do a dive into that if you're really into this product and go from there. But I'm going to jump off of this and I'm going to go into going to our portal. So give me a second. I want to make sure it shows up right. I'm going to go into our portal right now. And farwholesale.com. Let's go. Interesting. Okay. So let me go in here. Can you see my screen now on the portal?
Yes.
Okay. So I'm on the Finance of America Wholesale. I'm going to log in here, and you all need credentials. This is a must takeaway. Okay. So if you don't have credentials here, just shoot an email over, or you sent me
I sent you a list of everybody. Yeah, you can just.
Yeah, then I can get those taken care of. But you should be getting an email accessing this. So you want to get in here because look, marketing, you have it all right here. Flyers and brochures, email campaigns, social media graphics, guides, non-branded videos, working with verticals. If you want to work with financial planners or CPAs or real estate agents, general reverse stuff. It's all right here for you just to go in here and grab and get customize this material. So there's no excuse, not to go out to the public with something because we have them all set up for you. Okay, so that's one. Get in here and start playing around some marketing stuff and let the universe know this is a product you offer. There's a huge need, so people will start hitting on it. And then you can always have my team help you with the proposals and disclosures until you feel comfortable. I'm going to go right now into Illustrator. Now, Illustrator is a great tool just to quickly price the scenario. It does not give you the compliant component we talked about. Does not give you that proposal that you have to have. But this will give you an idea with some basic date of birth, value, zip code, and mortgage payoff estimates of what could be possibly happen here. So now I've got a grid of, okay, I got an adjustable rate HECM, I got a fixed rate HECM, a Home Safe Select, which is an adjustable rate. I got a Home Safe Standard, which is a fixed rate. I got a Home Safe Second. So I've got all these products available to me in the reverse world. I'm going to go into Illustrator. I'm going to click on Illustrate, and I want to see more deep dive into this product. Now I can change my margins here, which changes the rate. And remember, the lower the rate, the more we can lend, but it also affects your compensation. So I'm going to play with that a little bit. I can play with the lump sum and line of credit, cash requests. So I can play with this pretty good. But where I'm going to go is my amortization schedule. Because I already told you what I like to do is I like to be different. So if I show the senior the amortization schedule of their loan balance going up each month or monthly, which shows yearly, but it goes up monthly. I show them a line of credit growing. These are still nice win-wins. That's fine. But if I show them what it would look like the gentleman that came to me and said, I want to lower my monthly mortgage. I want to lower my monthly mortgage payment. I'm going to work for the next however many years. And instead of paying $2,500 a month in mortgage, I'll just want to pay $2,000, for the next, I don't know, say 4 years. And then I recalculate this. Now I can show him pushing and pulling on this loan, pulling money out, making payments to it, adjustments. But what I want to show him is you have control. That first slide, you have freedoms. Now look what happens to your loan balance. Your loan balance is going down. So it's no longer negative amortizing. That fear of you're going to steal all my equity or blow through my equity position, that's gone. It's your freedom, your control to do what you want to do. But more importantly, the line of credit is growing massively. So that in 4 years, you almost have $500,000 in a line of credit sitting there. And that's a nice insurance policy against retirement. So that's the freedom I want to show them, that a reverse mortgage isn't as simple as let your equity pay your deferred interest. It's way more than that. It's
Brad,
freedom.
Real quick, on the equity growth versus if you didn't make a payment at all, how are you seeing the equity growth versus the negative amortization on the interest that's being added to the balance? Are you seeing that that the equity growth is staying stable at the same rate or greater than?
It is the same rate.
Same?
It is the same rate.
So the equity growth is out or is keeping up with pace on what they're adding in.
It's the same rate. So if your interest rate on the loan is 7%, your line of credit growth is 7%. If the index comes down and now your deferred interest is 5%, your line of credit growth is 5%.
Got it.
So they mirror each other. So it's like the teeter-totter. If you have a huge line of credit and a small loan balance, you're okay taking a high interest rate because your loan balance is very small and your line of credit is growing at a huge rate if it's 7%.
Right.
Whereas the other side of the stick is if you have a high loan balance and low line of credit, right, you'd probably want a lower interest rate. So
one of the things that a lot of people push back on is, that they don't want to leave their heirs debt, right? Yep. And I tell them, you're crazy. If you think this is debt, leave it to me. I'll be more than happy to take this debt. It's an appreciating asset. But so the way I pitch it, is I show them, if you got $1 million and you're only taking out, 300,000, you still have 700,000 that, if you died tomorrow, your heirs would still have $700,000.
Yeah, but I 100%. And okay, so this is showing at a 4% appreciation. Right. Historically, we've had over 7%. Right. Current interest rates right now are only 6.5% for a reverse mortgage.
Yeah.
So if you had a 7% growth rate on your house and your interest deferred is only 6.5%,
Yeah.
you're still
You're outpacing it.
right. Yes, exactly. And that's without making a payment.
Yeah.
So people don't understand that. I look at it like this in the sense of people come to me and say, well, this, that. I'm saying, okay, well, let's say you had $500,000 in your savings account right now,
uh
and you have no way to get to it. It's just sitting there. And you're like, hey, but I can't get to it. I can't get to it. Okay, well, then the bank allows you to have an ATM, a checking book, and an ATM card. Okay, now you have access to your $500,000. So it's your discretion what you do with your money in savings. All we're doing is taking your equity and turning it into a savings account where now you have access to it. What you use it for is your responsibility,
Right.
right? Doesn't mean you have it and you have to go blow it. It literally just means you have access to it. No different than if I opened up a savings account for you, right?
Now, can I ask one other question about comp? So if they get a line of credit for 300 grand and they decide not to draw anything at the close, is the comp based on like a what's the comp? Is comp based on the loan, the principal limit that they're approved for, or is it based on
No,
the draw
it's
amount?
based on the draw amount.
It is, okay.
So if you go into this and you go, let's say we're at this 2.5,
Yeah.
and they only take 20%, right?
Mm-hmm.
You're at almost 10 points. So the
Got
way
it.
that would work is the fees, let's say you charge the 6,000 origination fee, and
Right.
then you have the mortgage insurance premium and the other fees. So let's just call that roughly $30,000 in fees. So
Okay.
now you're 10% on 30,000, you're still making the 3,000 back end plus the 6,000 origination. So you'd still probably end up with 9 to 10K on this file,
Right.
even if they took very little. So
Right.
you can see the scale here, 13 to 10%. You
Right.
can bump it up even higher, but that's kind of where you would be. And you definitely charge an origination fee on that type of file. Where
Right.
if you went to, let's say, 2.5, and the guy's, in here at 5 points on $500,000, you might not charge the 6,000 origination. You
Right.
know what I mean? That's
Right.
the freedom to you.
Gotcha.
Protect yourself.
Got it.
Right. So I went through a lot, but the idea, like I warned you guys early, was identifying the opportunity, right? If we can identify the opportunity, then we know we can dig in deeper. Or, there's a lot of opportunity out there. We just have to know what we're looking for. When you get a senior coming to you asking you for certain things, is it really best to rewrite that loan and recast their loan, or is it better to look at a reverse mortgage and maybe show them what it would look like making payments to it, right? Just different ideas, different concepts they like to run. Okay.
Yeah, that calculator is amazing. That's so cool. Can you change the home appreciation value or any of the
Yep.
values? Yeah.
You can change that. You can change all this. You can adjust the interest rate. You can get
Nice.
in here and say, well, for the first 4 years, I want to make payments. And then after that, I'm going to definitely retire. I'm going to start pulling $10,000 a month from the line of credit.
Right.
You can push and pull on this. So if you get in front of a financial planner and they're like, well, show me this or show me that and blah, 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 you can really easily show this,
Nice.
as life changes. So it's not stagnant, showing them that it's one way. This is a tool, it's a financial tool, how you can use equity to help with your retirement. If you do it right, you can increase your life estate. You're not sitting here losing equity and not giving your kids a better life for their inheritance. If you do it right, you could increase your life estate, right?
Yep.
Cool. All right, guys. Well, I'm already a couple of minutes over. I know we want to hit some good topics, and we did that. Make sure your takeaway here is getting into this portal, play around with it. If you've got leads, you can easily send them over to the team. We'll help you build stuff out. It's doesn't harm you in any way, shape, or form. And we can also, Quantum Reverse is a very easy LOS that you can use. I mean, it's super simple. Don't be afraid of it. You get in here, it's web based. You get access to this and you can play around with it. Right? You can see my screen still. It
Yep.
looks weird.
Yep.
Okay.
You can see it.
So you can get in here and play around, and it's just an LOS like Encompass or Point or whatever you guys are using now. You just go new and you start typing in the basic data points like you're taking a 1003. We use a 1009. You don't even need that much name, date of birth, zip code, estimated value, estimated payoff, and you create a loan. Like I said, we're not trig. You're not going to hurt anything, and you can get in here and start messing around. Okay. There's some really good, easy videos on training for the system. Okay.
Cool.
Awesome, guys. Well, thank you for the time. And if you need anything, shoot over an email to Team Brad. We'll get you guys set up. If you have any questions or you want me to go into any deeper dives, I have everything, job aids, whatever you want. Just let me know. Okay, guys?
Perfect. Thanks, Brad. Really
All right.
appreciate it,
Thanks,
bud.
guys. No problem. Take care. Have a great day.
All right, no worries. Okay, guys, again, I'm
Thank you.
gonna upload this right now as soon as it finishes in for those that missed it.
Yeah, thank you.
Yeah, no worries.
I was tied out.
I'm gonna upload it right now. So let me just end recording.